I think, if anything, it's made us, the current environment with geopolitical volatility, macroeconomic volatility has made us more committed to global diversification. And, we've been investing globally for over 25 years. And we've, businesses in Europe, India, China, Southeast Asia, Latin America. We've got investment teams on the ground. And it's been about 50% of our investing activity has been outside the U.S., really for the last 15, 20 years.
And so that ratio, it hasn't changed at all. You're just keeping it and you're committed to it then?
Yeah, our investment strategy is bottoms up. We try to find investment opportunities all over the world, but we have a lot of conviction that global diversification is good for our clients in terms of managing risk, but also finding opportunities. And we find great entrepreneurial companies all over the world. Last year, I just mentioned two of our most exciting investments. One was a female-founded beauty company in Dubai, but 95% of the revenue being outside of the Middle East. And it was the leading fragrance brand at Sephora last year. So, only by having investment teams on the ground in the Middle East are you going to find an opportunity like that. And we talked a bit about Japan, and same thing there, an investment team on the ground finding a great new software company in Japan.
How are you feeling about China at the moment? Because it's an area where you have historically been active. There was a moment where General Atlantic pulled back a bit. Are you now fully back in the country? Do you think seem settled enough geopolitically that it's once again an attractive geography for you?
We've actually sustained our commitment to China over the last 25 years. We actually started our office and opened our business in China in 2001 and been investing there for quite a while. And I would just say that China, as the second largest economy in the world, as a center for innovation in lots of areas like green technology, is only gaining pace and creating significant opportunities. It is more complex to invest in China, given the geopolitical issues between the U.S. and China. But I think investors are really going to be missing out if they're not active in China going forward.
How do you then decide that when there's headline volatility of latest trade missives or concerns around what the president is going to say about involvement? How do you decide what's noise and what actually impacts your investment outlook?
Well, you've got to combine the micro and the macro. We start from a micro view, the attractiveness of the company, its market position, the size of its market opportunity. We start there, the quality of the entrepreneur, and that's what really drives our investment program. But we've got to put it in a macro context. And the macro context for China right now is more complex than it was, let's say, in 2008 at the peak of sort of U.S.-China relations.
So what does it mean when it's more complex? How does that change how you operate?
Well, there's more restrictions on what we can invest in and can invest in. If you go back into the 2000s, the market was pretty wide open in terms of backing entrepreneurial growth companies in the private sector. Today, there's just more restrictions. Technology crosses over to national security concerns for both countries, and we've got to take that into account.
And this is an administration in the United States that has been very keyed in on this. And you're no stranger to this, having TikTok being in your portfolio of companies that have had to deal with this administration being involved in deals. How do you view that, the White House taking a more active approach among corporate America?
Well, my fundamental view about the Trump administration is that they're pro-business, pro-market, and that's been positive. It's been positive for business, and they've encouraged commerce globally. They've encouraged investment globally. They clearly want more investment in America, and that's a good thing. But they've been incredibly supportive, and I think they were quite constructive on TikTok. They recognize that there's 200 million monthly users in America, customers that love TikTok. And they wanted to find a way to safely make it available for Americans, and they found a good solution.
Does it change at all how you invest in terms of maybe things like national security, being more interested, those kinds of themes than they once were?
Well, I think there is a convergence of technology and national security that one creates significant investment opportunities on one hand, and we've got to take into account. But we are in a world where geopolitical risk is elevated. And I think back over my career, a 30-year plus career of investing, and it used to be you were more concerned about macro issues. What's the GDP growth rate going to be? Is there going to be inflation? What are interest rates as the primary driver of the macro context? Now it's geopolitical risk. Now it's like, what's going on with U.S.-China? What other flashpoints might exist that could be a significant, risk for a new investment?
Well, that's the thing, because this is supposed to be the year of M&A, the year where everything comes back. Do you think geopolitics slows that down a bit, or have businesses just learned to cope with it?
I think business leaders have done a better job understanding and navigating the external environment. And I do think M&A is going to come back in a significant way this year. one thing we've thought a lot about is that we had an exit recession for the private equity industry, during the 21 to 24 period. It was a very, very tough time. Unconventional antitrust policy. I think heavy regulation coming out of the SEC. The Trump administration has given us a much more pro-business, as I said, pro-market environment where I think companies are thinking strategically, are thinking, what is the M&A move that I need to make that really strengthens my competitive position? And so I think we're going to have an active period.
How active? Can we ever, for example, rival the years of 2021 and 2022?
I think from an M&A point of view, it's going to be the most active M&A market we've seen in a decade. And I think a lot of companies are saying to themselves, we've got a good economy, rates are turning down, flat to down. This is a very good environment for us to really, think strategically and think about consolidation in their markets. So I think, what I see below the waterline right now is a lot of dialogue among executives about trying to get things done. I think that will materialize into M&A deals over the course of the year.
And I know you spend a lot of your time talking with entrepreneurs. What are you hearing from them? What is the angst, and what sort of advice are you giving them right now?
Well, I think it's hard being an entrepreneurial CEO because you've got to navigate the external environment while still running your company day to day and navigating rapid growth. So what I've really tried to communicate to them is say, look, invest in your team, build a great team so you've got more capacity to manage the external environment. And we try to be a great partner. We're an active investor. We work in partnership with our entrepreneurs. We try to be a resource to them to help them navigate a more complicated environment and think about M&A creatively.
How are the entrepreneurs of software companies feeling at the moment, Bill?
Well, it's been an interesting week.
That it has.
But the way I look at it, I still believe most of these software business models are quite durable. And I think when you have applications that are integrated into business processes with data embedded, I think they're going to be, remain critical. And I think AI is a potential enhancement, actually, versus a risk. So, excuse me, I'm less concerned about the displacement of these companies. But what has changed is valuation.
Yeah.
10 years ago, software companies were valued at about 4 times revenue, and they went all the way up to 10 to 12 times revenue at the peak in 2021, even into this period. And I think they've come back down to where they were, about 4 times revenue. So valuation has changed. I'm not sure the business models have changed that much.
What's allowed us to reconsider and rethought the prices we should be willing to pay for these companies?
Well, I think that there was. I think there's some questions about what is the growth rate going to be for this industry with AI, and will AI siphon off some of the future growth, or will it enhance the existing competitors? I think it's going to be a little bit of both. I think you're going to have some new AI-driven application companies that are going to take some market share and actually represent some very exciting investment opportunities. But then you're also going to have some, I think, existing companies that will harness AI and create a new wave of growth. So I think it's a little bit of both. But I think the market is saying, until I understand more about what AI is going to mean and what it means for growth rate, I'm going to take a more cautious view on valuation.
What about the other side of the coin, which is the huge amount of spending that AI companies are doing? You and your team at GA obviously are experts at analyzing businesses, and tech businesses specifically. It's a sector that used to be loved because cash flows came in, margins were really good. Yeah. Is it concerning, or how do you view a tech sector now that's increasingly having to spend more money and also spending it on things like infrastructure and heavy assets?
Well, it's a significant change, but if I just step back for a minute, this is the fifth major tech cycle that I've been involved with. I think back to the PC cycle of the 80s, the internet cycle of the 90s, the mobile cycle of the 2000s, cloud in 2010s, and all of these cycles, you created very large new markets, introduced new business models, great new competitors, and they didn't just change the tech sector, they changed business and society in some fundamental ways. And I think AI is the next great wave of that kind. It might even be a super cycle that builds on 40 or 50 years of development in the tech sector. So it's huge. But I think there's real information in the level of spending from the tech giants that I think hasn't been talked about enough, which is I think they see what we see. There's tremendous demand going to be tremendous demand for AI, almost infinite demand. It's going to feel like infinite demand for the next 4 or 5 years. To me, the working definition of AI is it's intelligence on demand. And I think with the tech giants see is that there's going to be so many applications, so many ways for people to use intelligence on demand that they're making a very strong bet. They have tremendous conviction. Demand is going to be there. So the challenge is, can we supply it? And I think they're voting with their wallet. They're saying, like, look, we're so convinced of the demand side. We're going to move from an asset light, cash flowing business model to really put all our chips on the table and invest in the future. And I actually think it's a good bet because, again, the demand side is so strong.
So those bubble fears clearly aren't there for you.
Not for me. Look, there's questions. What's pricing like? What's business model? What's return on capital? I think those are all legitimate questions that will be answered, will have to be asked and will be answered in the future. But if I'm running one of those tech giants, to miss a leadership position in producing intelligence on demand for the future, which will reshape the entire tech industry, and will, as I said, I think will reshape business and society, you can't miss it.